For over a year, two of the world's largest shipping companies refused to sail through one of the most important waterways on the planet. Now they're going back, and that decision ripples far beyond the ships themselves. Maersk and Hapag-Lloyd, two of the biggest names in global container shipping, have announced they're beginning a return to the Suez Canal trade route. After more than a year of avoiding the canal entirely, both companies are signaling that conditions have changed enough to justify sending vessels back through that corridor. This is a significant shift. These aren't small operators. Together, Maersk and Hapag-Lloyd represent a massive share of the world's container shipping capacity. When companies this size change course, the entire industry pays attention. The Suez Canal route connects Europe and Asia through the Red Sea, and it had become too dangerous for commercial shipping to use safely. Now, it seems, the calculus is changing. To understand why this matters, you need to appreciate what the Suez Canal actually does for global trade. Opened in 1869, the canal cuts through Egypt and links the Mediterranean Sea to the Red Sea, effectively connecting Europe directly to Asia and East Africa without ships having to sail all the way around the southern tip of Africa. That alternative route around the Cape of Good Hope adds thousands of nautical miles to a journey. Depending on the vessel and the destination, rerouting around Africa can add anywhere from 1 to 3 weeks to a voyage. In shipping, time is money, literally. Longer routes mean more fuel burned, more crew hours, more wear on the vessel, and higher insurance costs. So the Suez Canal isn't just convenient. It's a critical artery in the circulatory system of global commerce. Roughly 12 to 15% of global trade passes through it in a normal year. Everything from electronics and clothing to oil and machinery. When that route gets disrupted, the effects show up eventually in prices, delivery times, and supply chains around the world. And that's exactly what happened when Houthi militant attacks in the Red Sea began forcing shipping companies to reroute starting in late 2023. Here's how this situation developed, and why shippers are now cautiously returning. The Houthi movement, based in Yemen, began launching drone and missile attacks on commercial vessels in the Red Sea in late 2023. They stated their attacks were in solidarity with Palestinians during the conflict in Gaza, targeting ships they claimed had links to Israel or its allies. The problem is that commercial shipping is not a precise thing to target. Vessels from all over the world use the Red Sea corridor, and the threat quickly became indiscriminate enough that virtually every major shipping line decided the risk wasn't worth it. Maersk and Hapag-Lloyd were among the first major operators to announce they were pausing transits through the area and rerouting around Africa. Other carriers followed. The impact was immediate and significant. Freight rates, the cost of moving goods by sea, spiked sharply, as longer routes meant less available capacity. Port congestion increased in certain regions. Delivery timelines stretched. It was a vivid reminder of just how fragile and interconnected the global shipping network really is. Now, more than a year later, the security environment appears to have shifted. A ceasefire agreement in Gaza has reduced the immediate intensity of the conflict, and there are indications that Houthi attack activity in the Red Sea has decreased meaningfully. That's given Maersk and Hapag-Lloyd enough confidence to begin, cautiously, resuming transits through the canal. It's worth emphasizing the word cautiously here. This isn't a full unconditional return. Shipping companies are monitoring the situation closely, and decisions will continue to be made on a voyage-by-voyage, fleet-by-fleet basis. But the direction of travel is clear. So what does this mean for the people and businesses that depend on global shipping? A few things worth thinking through. First, capacity. When major carriers rerouted around Africa, the effective capacity of the global shipping network shrank, not because there were fewer ships, but because each ship was tied up for longer on each voyage. A vessel that normally completes a round trip between Asia and Europe in, say, 6 weeks, might have been taking 8 or 9 weeks via the Cape of Good Hope. That reduces the number of round trips a ship can make per year, which tightens available capacity and tends to push freight rates higher. As ships return to the shorter Suez route, that bottleneck eases. More capacity comes back into circulation. That's generally good news for importers and ultimately for consumers, because the cost pressures that built up during the disruption begin to unwind. Second, supply chain predictability. One of the least visible but most important things in global logistics is predictability. Businesses plan inventory, production schedules, and retail deliveries based on expected shipping times. When ships are adding 2 or 3 weeks to their journeys unexpectedly, that planning falls apart. A return to the Suez route means more reliable, consistent transit times, which allows businesses to plan better, carry less emergency inventory, and operate more efficiently. Third, and more broadly, this is a signal about the geopolitical environment. Shipping companies are ultimately making a risk assessment. When Maersk and Hapag-Lloyd say they're returning to the Red Sea corridor, they're saying, implicitly, that the threat level has dropped to a point where commercial transit is viable again. That's a data point about the state of the conflict and the region, not just about shipping. Of course, the situation remains fluid. The Houthi movement has not disarmed, the underlying conflict has not been fully resolved, and conditions could change again. If attacks were to resume at scale, carriers would face the same decision they made in late 2023. The shipping industry is pragmatic. It will adapt again if it needs to. But for now, the return of these two giants to the Suez Canal route is a genuinely positive development for global trade flows. So how do we classify what's happened here? This is a geopolitical risk event unwinding, a situation where external conflict forced a major disruption to a critical piece of global infrastructure, and conditions have now improved enough to allow a partial recovery. It's a reminder that global trade doesn't operate in a vacuum. The economics of shipping, the routes, the rates, the timelines, are deeply sensitive to political and security conditions in a handful of strategically vital choke points. The Suez Canal and the Red Sea are among the most important of those choke points. When they're disrupted, the costs are diffuse and slow-moving, spread across freight rates, supply chains, consumer prices, and business planning cycles. When they recover, the benefits are similarly diffuse, but real. For investors, this kind of event touches multiple sectors: shipping companies directly, but also port operators, logistics businesses, retailers with complex supply chains, and even inflationary dynamics that central banks watch closely. It's not a dramatic single-day market event. It's a slow-moving structural shift that quietly reshapes costs and timelines across the global economy. The return of Maersk and Hapag-Lloyd to the Suez Canal route is, in that sense, genuinely meaningful news, not just for shipping, but for anyone who cares about the health of global trade. If you found this analysis useful, subscribe to Investors Club Global for more clear, trustworthy breakdowns of the financial news that actually matters. Hit the like button if this helped you understand the story, and drop a comment below if there's a topic you'd like us to cover next.